Hi everybody, I'm Colby Cox.
And I'm Rodolfo.
Now we're with Global American Financial. Today we want to talk to you a little bit about the history of life insurance. And life insurance has been around for a long time, right, man?
Yeah.
Absolutely, long time. And so, and things have changed over the last, 50 years. So we're going to start in the 60s and go from there. So in the 60s, that's where whole life was king, right?
Right, whole life was king up until that point. The idea was, you buy these life insurance policies, either, lump sums or just monthly payments, and you paid up for your whole life, and when you passed away, it passed on to yours tax-free. That was for the whole life. What happened was people started living a bit longer than what these insurance companies had planned for, and at times they just outlived life insurance policies. So people got a little unhappy with that. So you know what? How about I buy something where I know I'm going to get for a short period of time?
Mm-hmm.
And that's where I think it evolved to more like the 70s.
Sure.
With the buy term invested difference.
Buy term invested difference, absolutely.
Yeah.
You want to comment on that?
Yeah, so with the buy term, the idea was you buy for 10, 15, 20, 30 years, protect yourself for that time frame, but in the meantime you invest a difference into either mutual funds, stock accounts, and the idea was once you reach retirement age, you have all these investments to the point where you don't need the life insurance anymore.
Self-insured.
Right? You're self-insured in essence, exactly. Self-insured with these investments. What happened was people just didn't have the investments or didn't put money away for savings, right? So they reached retirement age at 60, 65 years old. Their term ran out, and the pricing just skyrockets once the term expires, and the investment didn't pan out. So now you're at retirement age, no longer insurable, no longer have life insurance, and your investments weren't really where they wanted to be.
Yeah, I mean, a lot of people just didn't know what to invest in or
That
where
too.
to invest in.
Or they took a lot of hits throughout the time.
They took a lot of hits. And, yeah,
exactly.
It dwindled down what they had. So, after the 70s came the 80s, and we had, is that how that worked, 70s and then 80s, right?
That's right. Yeah.
All right, and we had ULs, all right, universal life.
The universal life policies. And the idea was for that, one more flexibility and options than the buy term invest difference and a little bit cheaper than the whole life policies. But the way they designed the returns on those policies was they were tied to whatever the insurance company decided to pay out to their policyholders. Mm-hmm. So, for example, let's just say we're in a group of executives sitting in an office, and we have to determine what the yearly payout's going to be to our policyholders. I give you two options. I say we'll pay out our policyholders 6% because we had a good year, so let's return 6% to our policyholders, and you get no bonus, executive team. Mm. Or we give our policyholders 3%, and you as Mr. and Mrs. Executive get 3% bonus. How do you vote?
Let me think, bonus.
Bonus, exactly. So those didn't really pan out as well as they had hoped. And only that, but at the time in the 80s, interest rates were sky high, so the returns were actually pretty decent. Well, as we know, interest rates have continuously dropped over the last 2 or 3 decades, and it's just not where it needs to be. So the insurance companies have repriced their universal life policies, make it almost impossible to maintain at times. And so that didn't really work out as well as they had hoped.
Yeah, so after the 80s, we come into the 90s, and that is when the VULs, the variable universal life, came
right. So at that point, the variable universal life policies come into play. And the 90s were the perfect time for that because the stock market was just skyrocketing. The dot-com bubble and boosted throughout the time. It was, high growth. The economy was doing well in the United States, so variable made sense. So the idea was had a universal life policy, but the growth was tied to the stock market. You got the highs, but you also got the lows. And as we know, in 2000, we had the dot-com bubble burst, and then we had 9/11, and then we had the financial crisis 2008.
Wow.
So the variable policies did okay up until that point.
Sure. And then up until that point, that is when the IUL, the Index Universal Life, started to come out.
Right. So at that point, IUL started being introduced in the marketplace. And the idea with that was you're not directly investing in the stock market, but your returns are tied to a stock market index like the S&P 500. And the idea with that was they put a floor, so you never lost, but they also put a ceiling, so you can only earn so much. 0% floor, like a 12% cap, as an example. You earn anything between that. So that worked out well because it had middle risk, some returns, but you're not losing anything, right?
Sure.
So that's the evolution that we're at today, and who knows, 5-10 years from now where life insurance is going to be, but that's kind of where we're at today.
Okay, let me ask you then. Since there's so much out there, what's best?
Well, there's really nothing best. I mean, having insurance is always a good thing because you never know what's going to happen in life. Because one thing for certain is we're all going to unfortunately pass away, so we have to be prepared for that, right? Hopefully financially we have the right products in place.
Sure.
But from a life insurance perspective, it just depends what your situation is, right? I mean, I've sold life insurance policies where there have been people that buy for 10 years to cover a 10-year note, for a loan, and they just want protection for that in case something happens. Or people buy policies for their lifetime, like an IUL, that need protection until the day they die. They want to have it till they're 80, 90 years old. It just depends on what is specific to your situation. So there's really nothing that's best. It's what's best for you.
Sure. There's no such thing as bad coverage except for the coverage you don't have.
Exactly.
Absolutely. Well, we hope you learned a little bit of something today. Thanks for joining us. Y'all have a good day.
Thank you.